All right, topic A tonight, very important. Stocks diss oil, and stocks go for economic growth instead. This is hugely significant. The Dow up by nearly 200 points on only a small drop in oil, which after all still closed near $102. So what turned stocks around? Important growth signals. The ISM services beat all expectations. Better retail chain store sales and a big plunge in initial jobless claims. And by the way, the whisper number for Wall Street's tomorrow non-farm payroll approaching 300,000. We'll see. But Mr. Market told us today that barring a blow-up in Saudi Arabia, the economic recovery in the USA will continue without a train wreck. But you know me, I want to look at this in a sober manner. There are still reasons for caution, not least of which is the monster climb in gas prices at the pump. $3.43 at the pump nationwide today. That is a huge tax on consumers and small businesses. It could take a big bite out of recovery. Plus, inflation may be coming in higher than expected, even while growth is higher. And there still may be an interest rate day of reckoning for that inflation. So, question, are stocks trumping oil? Is today's trading really a pivotal moment? And what are the pitfalls that you, the investor, should be thinking about? Let's go to our investment panel right away. We have Joe Battipaglia, market strategist, Stifel Nicholas, Lee Munson, chief investment officer at Portfolio Asset Management, Brett Arends, columnist at the Wall Street Journal. Lee Munson will be on in a second. Brett, on set. Nice to see you. Start with you. No big oil plunge to drive up stocks today. It was all based on economic growth and recovery. Can it last? Is this a turning point in today's trading?
Well, I think there's quite a lot of short covering today. I think people are a bit worried about, some of the shorts are worried about what's going to happen on tomorrow's payroll number. A lot of people anticipating a big number. What's interesting is that trim tabs look at the payroll, the withholdings, the Treasury, and their model says that tomorrow may be a bit of a disappointment. They're predicting about 160,000 figure. Now, if that happens, we'll probably see a sharp sell-off in the morning. That's anyone's guess.
Of course, I don't know if anybody really pays much attention to these crazy weekly or monthly non-farm payrolls, but we'll see. Lee Munson, I want to ask you the question. It's nice to see you again. Did we have a pivotal turning point day today? It wasn't falling oil. It was rising economic growth stats that seemed to drive the market. And Mr. Market looks like he is saying to us, the economic train wreck from oil spikes will not happen, Lee Munson. Does that open the door to a bullish market again?
Yes. I mean, come on. It's Thursday night, Larry. Let's make fun of Charlie Sheen and just say, Mr. Market says, winner. Okay? I say I'm a buy winner. Listen, I'm winning on my financials. I'm winning on my grain stuff. I'm winning on my commodities. But more important, Larry, the reason why we have such high spike right now, a lot of it is psychological because of the Middle East situation. But we have higher commodity and oil prices because we have industrial production. People are consuming more. So I think this is an excellent number. And you know what? As a trader, I do listen to those weekly numbers, and they're great to trade off with. But outside of that, I think we're going to be okay.
All right, Joe Battipaglia, I want to ask you the flip side of this. There are issues. You had big prices paid in that blowout ISM services number, just like we saw in the manufacturing ISM. Big prices paid could spell big inflation, which down the road could spell big interest rate hikes, whether the Fed likes it or not, Joe. Is that an issue on the board?
Well, here's where we go into the darkness, because the Federal Reserve through QE2 is positioned to have to do something at some point. They believe that once the inflation starts to reappear and bank lending hyper-accelerates, they'll be able to gently remove the punch bowl. The market's probably not convinced of that. In fact, they're going to look very carefully at this because, indeed, the inflationary expectations are beyond 2% now. They're in a dangerous zone. And if they sustain there, the Fed have to move early. If they move early, it's a signal to the markets. Rates bounce terribly the other way today, which is something we have to watch very carefully because that's competition
Joe,
against stocks.
How much is dangerous, though? I don't think dangerous is just because we're up 2%. Even if we're up 2 or 3%, it's the emerging markets that people should be worried about, and they're the ones that have to buy our, that last barrel of oil in dollars at a higher price with the currency that they're the one debasing their currency because of inflation.
But is there too much?
Yeah, but remember the surrounding.
Now,
remember
go ahead, Joe.
Remember the surrounding weakness, and that is to say we have a very high unemployment rate. We have difficulty in housing. If interest rates move against us because of the inflationary expectations, it'll damper down how this economy behaves in the future. And today's a good example of that. Stocks were up great, but the bond market took it on the chin.
Brett Arends, though, I want to ask you this. I thought from the very moment that ISM services number came out, non-manufacturing, it kind of said to the market, and the market ran with that ball, you know what, all this oil shock, it really is only about $10 or $12, barring a blow up in Saudi Arabia, which I acknowledge would have incalculably bad consequences. But barring that, we've all obsessed too much about oil, including yours truly, and the economy in February is just fine, thank you very much. What is that? That's a possibility. It's almost like the surprise entrant in this contest.
Well, it would be surprising if the economy weren't showing some signs of improvement, given the amount of money that's thrown at it. I mean, the fact is a lot of this is bought with borrowed money. There's a big, when people look at this at home in terms of their own portfolios, the big question is, are you trading or are you investing? If you are trading, there may be a lot of momentum to come. I'm not going to call that either way. If you are an investor, the problem is this market has already anticipated quite a lot of good news. And of course, when you buy this kind of growth with borrowed money, at some point you have to start reeling that back in. If we see costs rising, we see interest rates rising, those come off back in. The truth is stocks are quite expensive on a lot of measures. I don't think, frankly, I never want to buy expensive stocks in any environment.
Well, that's an interesting point. Lee Munson, what about this gasoline story? You're almost at $3.50. You're up 25-30% from a year ago. That's bad for consumers. It's a tax. It's bad for small business. It's bad for people that go around the country in trucks and cars to sell their wares. What about the gasoline tax problem?
Yeah, Larry, and I disagree with Brett to a certain extent, because what about it? A year ago, how much industrial production did we have? We're talking about a year ago prices being higher, but a year ago we didn't have the same type of demand. We didn't have the same type of industrial production that we do now. I feel like everybody is taking some page out of Economics 101 saying input prices are up from this period. I mean, quite frankly, I use Economics 101 textbooks as kindling for campfires out here in New Mexico, and I think you're just taking one part of it. Listen, I like Brett a lot, but I think that he's talking about, Shiller and all of his work. Shiller's great if you have 2 or 3 years to prognosticate on the topic.
Lee Munson, my love. What does your Econ 101 say that you're going to use kindling? Before you use it for kindling, what does it say about jacking up gasoline prices at the pump? All right? What does it say about that?
It's a tax. You're right. It's this tax. But I would say if the consumer has a propensity to spend after 2 cold winters, number one, and industrial production is up higher, I think it's more than going to make up for this sharp increase. But guys, gasoline is up a lot because we have West Texas Intermediate crude trying to follow Brent crude, and all it is a bunch of speculators, short term, storing this stuff, trying to make a play. It's going to come get slapped.
All right, I don't want. All right, enough.
3 months
gasoline.
from now, I don't think it's going to be that
Can I
high.
ask you an investment question? You can be bullish, but you can also have a lot of cash. Is that possible, Joe? In other words, you've got days of rage coming in Saudi Arabia on March 11th. No one, least of all myself, knows what is going to be is going to happen with that, what that's going to bring. You've still got issues in Libya. You've still got issues in Oman. Bahrain, of course, is right next to Saudi Arabia. Joe, can you be bullish but still raise more cash right now?
Well, the problem is the Federal Reserve is pushing you out of cash to take more risk. So that means that your high-yield bonds, your foreign bonds, commodities, anything with a risk attached to it is going to attract attention here because you can't get a return on cash. So clearly what you want to be in your portfolio is have some gold as a hedge against those conditions, have commodities, have energies. At these levels, everyone's making a lot of money, clearly. Assume you're right on the economy absorbing $100 a barrel.
Well,
you can still play the industrials.
I don't know
but cash
that I'm
is a
right.
tough place.
All I know is this is what Mr. Market told me today, and I was very impressed with the trading.
Yeah, but remember what Mr. Market told you 2 days ago. Remember what they told you 2 days ago when we dropped 165.
Yeah, but
all was lost.
But
so
that was an oil spike. That was a couple dollars. Today was like nothing in the oil markets. That's what interested me. We're out of time, Jim. We'll have to debate this again. Joe Battipaglia, Lee Munson, Brett Arends, thank you ever so much.